You're sitting in your car in the bank parking lot, engine off, phone in your hand. You've been staring at your banking app for 3 minutes, trying to decide if you should go inside. There's a hold on your account, some automated fraud detection thing. Your rent check might bounce if you don't get it cleared today. You know what's waiting for you there? The cue, the explanation, the subtle implication that somehow you did something wrong, the anxiety of wondering if they'll even fix it. You take a breath and walk in anyway, because you don't have a choice. Now, imagine a different version of this. Same hold, same bank, but when you call, you don't get a menu tree. You get Jennifer, your relationship manager. She already pulled up your account before you finished explaining. The hold is released while you're still on the phone. 2 minutes. Done. What's the difference between these two experiences? It's not about who you know, it's about a set of invisible benchmarks that most people don't even realize exist. And once you understand them, you see the entire financial system differently. Most people think banks treat everyone basically the same. Sure, maybe billionaires get special treatment, but for regular people, you open an account, you get a debit card, and that's that. But that's not actually true. Banks have 3 distinct service tiers. They're not advertised on brochures, they're not explained during account opening, but they're built into every system, every policy, every interaction. And the moment you cross into a new tier, everything changes. The fees disappear, the access expands, the friction evaporates. I'm Zick. And what I'm about to walk you through isn't about becoming wealthy, it's about understanding exactly where you stand in the banking hierarchy and what it takes to move up. Because these aren't arbitrary numbers. They're intentional thresholds designed to separate customers the bank wants to keep from customers they're okay losing. Let's start at the bottom. Level 1, the retail tier. This is where most people live. Total deposits and investments below $50,000. At this level, you're not really a customer. You're a transaction processor. The bank makes money from you through fees, not from investing your deposits. Here's what that looks like in practice. You get charged for everything: monthly maintenance fees, overdraft fees, ATM fees, wire transfer fees, even paper statement fees. If something goes wrong, you call an 800 number. You explain your situation to someone reading from a script in a call center somewhere. They transfer you. You explain again. Maybe it gets resolved. Maybe it doesn't. You have to go into a branch for anything complex. You wait in line. You're treated with polite efficiency, but zero personalization. And here's the psychological weight of this tier. You're constantly defending yourself. Every transaction feels like it could trigger a problem. Every fee feels like punishment. Every interaction with the bank feels adversarial. You're not paranoid. The system is actually designed to extract value from you, not create it for you. And here's what living in this tier does to your thinking. When you're constantly managing small financial fires, your brain doesn't have room for strategic planning. Should you refinance your car loan? You don't even look into it because the idea of dealing with another financial institution feels exhausting. Should you open a high-yield savings account? You know you should, but the friction of moving money around, setting up transfers, learning a new platform, it's too much. So you stay put. And every day you stay put, you're losing ground. Not because you're lazy, but because your cognitive bandwidth is maxed out just keeping things from falling apart. This is what scarcity does. It narrows your focus to immediate threats and makes long-term optimization feel impossible. But here's what changes everything. There's a number that gets you out. Level 2, the preferred tier. The second tier is the preferred tier. This kicks in around $50,000 to $250,000 in combined balances. This is where the bank starts seeing you as profitable. Here's what changes immediately. The fees stop. Not because you negotiated, because the system automatically flags your account as valuable enough to retain. You get a dedicated phone line, not a relationship manager yet, but a priority queue. When you call, you're not sitting on hold for 20 minutes. You qualify for relationship pricing, better interest rates on loans, higher yields on savings, waived wire transfer fees. But the real shift is psychological. You stop feeling like the bank is working against you. You start feeling like you're working with them. And that shift in posture changes how you make decisions. You're not afraid to call anymore. You're not embarrassed to ask questions. You start using the bank as a resource instead of avoiding it like a threat. Let's talk about how you actually cross from retail to preferred. Let's say you're starting with $5,000 in your checking account. That's your base. You commit to saving $750 a month. It's aggressive, but not impossible if you're intentional about your big expenses. In 5 years, you've saved $45,000. Add that to your starting 5 and you're at $50,000. But here's where it gets interesting. If you're investing that money instead of just stacking it in savings, let's say in a conservative allocation getting 6% annually, your balance grows faster than your contributions. Year 1, 9,500. Year 2, 19,800. Year 3, 30,900. By year 5, you're not at 50,000. You're at 57,000. You crossed the threshold ahead of schedule, not because you got lucky, because you let compounding do the work. But the real transformation isn't financial. It's the person you became while getting there. You became someone who automates their savings, someone who doesn't touch their investment accounts when the market dips, someone who can delay gratification for 5 years. That's rare. That's valuable. Not just to banks, but to yourself. Because once you've proven to yourself that you can execute a 5-year plan, everything else becomes easier. Job not working out? You're not panicking. You've got 57,000 and a track record of discipline. You'll figure it out. Opportunity comes up, you've got capital, you can move. You're not a different person because you have more money. You're a different person because you built the capability to accumulate and protect it. Level 3, the private clients tier. The third tier is private clients. This typically starts around 250,000 and goes up from there. This is where banking becomes a completely different experience. You don't have a phone number anymore. You have a relationship manager, someone who knows your name, your goals, your financial situation. You want to buy a house? They pre-approve you before you even look. They know what you can afford because they're tracking your finances in real time. Do you need a business loan? They structure it for you. They know your cash flow. They know your assets. They can make decisions without sending you through underwriting. You have a problem at 9 p.m. on a Saturday. You text your manager. They handle it. But here's what matters more than the convenience. At this tier, the bank starts proactively making you money. They call you when interest rates shift and suggest refinancing. They alert you to tax-advantaged investment opportunities. They introduce you to estate planning attorneys and CPAs. You're not just a client, you're a relationship the bank is actively trying to deepen. And here's where these tiers create fundamentally different realities. Let's say your water heater dies, $8,000 to replace. Retail tier, panic. Do you put it on a credit card? Do you drain your emergency fund and leave yourself exposed? Do you get a payment plan and pay interest? Preferred tier, annoying but manageable. You move money from savings, handle it, and rebuild the buffer over the next few months. Private client tier, you call your relationship manager, ask about a short-term personal line of credit at a favorable rate, replace the water heater, and pay it off when it's convenient. Same broken water heater, 3 completely different emotional experiences. Or let's say your company's being sold. You're getting a payout, $75,000 in stock options. Retail tier, you take the cash, pay the taxes, and put it in your checking account. Maybe move some to savings if you remember. Preferred tier, you talk to a financial advisor, understand the tax implications, and invest it strategically. Private client tier, your relationship manager connects you with a tax strategist before you even execute the options. They model out multiple scenarios, optimize for capital gains treatment, and integrate it into your broader wealth plan. Same payout, massively different outcomes. And here's what people get wrong about moving between these tiers. They think it's about optimization, cutting subscriptions, buying generic brands, skipping coffee. Those things might help, but they're not what moves you up. What moves you up are the structural decisions. Housing. If you're spending 50% of your income on rent because you wanted to live in a trendy neighborhood, you're stuck. You'll never accumulate enough to hit the thresholds. But if you're spending 30%, even if the place is less impressive, you've freed up 20% of your income permanently. Transportation, a $40,000 car with a 7-year loan versus a $15,000 certified pre-owned car you buy with cash. That difference, invested over a decade, is the gap between retail and preferred tier. Career. Are you at a job that pays $70,000 with no benefits, or a job that pays $65,000 but matches your 401k and offers profit sharing? Over 10 years, the second job puts you $100,000 ahead. Even though the salary was lower, these decisions don't feel dramatic at the moment, but they're everything. And here's something that happens as you move up these tiers. Your relationship with your employer changes. At the retail tier, you need your job. Every paycheck matters. You can't afford to rock the boat. At the preferred tier, you can handle a few months without income. So when your manager asks you to take on extra work without extra pay, you can say no, politely, firmly. At the private client tier, you can walk away entirely if the situation's toxic, not impulsively, but you have the option, and that option changes your posture in every negotiation. You're not begging for a raise, you're proposing a compensation adjustment based on market rate and your performance, and if they say no, you're genuinely open to exploring other opportunities. Your manager can feel that. Confidence isn't aggressive, it's just the absence of fear. And people who aren't afraid get better outcomes, but here's where people sabotage themselves. They finally hit the preferred tier, 50,000 saved, they're feeling good. So they celebrate. New car, vacation to Europe, upgrade the apartment. 6 months later, they're back at 38,000, and the bank's algorithms notice the fee waivers disappear, the priority service downgrades. They crossed the threshold and then walked back across it. I've watched this happen so many times, it's painful to see. The discipline that got you to the threshold is the exact discipline that keeps you there. There's no graduation ceremony where you get to stop being intentional. These tiers aren't achievements, they're states of being, and states of being require maintenance. Treat the threshold like a starting line, not a finish line. Every dollar you spend celebrating too early is a dollar that can't compound into real freedom later. Let's say you hit the preferred tier at 50,000. You're tempted to buy a boat, 25,000. That 25, left invested at 7% for 20 years, becomes 97,000. So you're not buying a $25,000 boat, you're buying a $97,000 boat in future purchasing power. Maybe that's worth it. Maybe the experiences and memories justify the trade-off. But you need to see it clearly. Most people don't. They just see the price tag today. They don't see what they're giving up tomorrow. And then they wonder why they never make it to the private client tier. Here's what most people miss about these tiers. Each one doesn't just give you better service. It accelerates your ability to reach the next one. At the retail tier, you're losing money to fees, you're paying higher interest rates, you're missing opportunities because you don't have access. At the preferred tier, those drags disappear. Suddenly, you're not bleeding $300 a year in fees. You're earning an extra point of interest on your savings. You're getting better loan rates that save you thousands. Those gains compound. They accelerate your progress to the private client tier. At the private client tier, the acceleration intensifies. You're getting tax strategies that save you 5 figures annually. You're accessing investment opportunities with better risk-adjusted returns. You're building relationships that create business opportunities. It's not linear growth, it's exponential. But you have to reach the first threshold to trigger the cascade. Look, I'm not saying everyone needs to reach the private client tier. Maybe preferred is exactly right for your life. Maybe that's all the financial infrastructure you need. But here's what I know. These tiers exist whether you acknowledge them or not. And the people who move up aren't smarter. They're not luckier. They just saw the structure clearly and made intentional choices. So here's what I want you to do. Figure out which tier you're in right now. Be honest. Then decide, Do you want to stay there or do you want to move up? If you want to move up, build a plan, not a fantasy, a real plan with real numbers and real timelines. Maybe it will take 3 years. Maybe it takes 7. The time will pass anyway. And when you get there, you won't just have better banking service. You'll have become someone who executes long-term plans, someone who makes disciplined decisions, someone who controls their financial life instead of reacting to it. The bank will treat you differently, but more importantly, you'll treat yourself differently. Your future self is watching. Make them proud. This is Zik. Thanks for listening.